Good evening, everyone. Time for another silver update. This is the 2-hour chart of silver provided by netdania.com. You can click on the link below. Now, there's a couple of things I want to point out on this chart. The first is going to be this primary trend line, and you can see that the number of touch points are very, very large. They're not perfect, but we're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, something like 13 touch points on this. So this is a very, very well established trend. Now, a lot of people criticize me and say, why do you look at charts? Well, I look at charts because charts tell you what has happened. Now, the chances of this pattern, of this trend channel being met and then failed consistently for that many number of times over a period, you can see it begins all the way back in April 25th or so, all the way up to the present. The odds by random chance of that occurring are infinitesimal. So that means something. That means that there are a lot of traders, albeit paper traders, but there are a lot of traders who are watching this trend line, and probably a lot of people who are manipulators who are watching this trend line as well. At some point, this trend line is going to be violated. Now, we know that that's the case because I did a measurement here. This first blue arrow is just at May 1st, and the next one is June 1st, just to get an idea of how fast this is declining. So if we do that measurement, we get roughly $1.50. We're talking 23.07 to about 24.57. We're talking $1.50 a month decline. Now, if you take $1.50 a month decline over 12 months, that gives you, from the current price, a price of $1 an ounce of silver. So, can this trend continue for a year? Yes, it can. Can silver go to $1? I guess it can. Will you be able to get any silver for $1? I highly doubt that. So that's very significant. It means something. Even though it's just paper, it still means something. They're still very, very involved in regulating the price of silver. So before I want to talk about some of the economic topics, I just wanted to jump over to the member forum. Now, give you some updates real quick. We have added a chat section that's over on the right. So if you want to chat, you can just go down here, click in the box, and send. And it shows the number of people logged in up here at the top. Now, the default avatar is the Gravatar symbol, and I've set it to that. There are very few. You can see Nirkabi has one. I have one. You have to set that at Gravatar. So if you don't have a Gravatar account, what you need to do is you need to go over to Gravatar and set that up, and then that will be, it has to be with the email address that you registered with. Then what this will do is it will pull that avatar. We're working on a manual avatar process, but it's very difficult. So if you really want an avatar, go over to Gravatar. And so a lot of people have supported us. We've added forums, and I just really want to thank all the new members. I really appreciate your support. I also want to thank Kevin, our tireless techno guru, who's helped us. We simply couldn't have done it without him. And I'm very pleased with the launch of the member site. Hopefully it's going to be a community for people who are interested in getting together and talking about stacking physical silver. Now, let's get over to the topic of the night. I'm going to start off with Eric King. This just came out, and I'm not going to go through and read this. I don't want to do any copyright violations, but I just want to show you some charts here that are on this. This is from Eric Pomboy of Meridian Macro Research. Just take a look at some of these charts to get an idea of where we're at. Now, of course, the first one is the gold net commercial. I don't follow that too much. I really wanted to show you the economic charts. That's real estate inventory. This is a very important chart. This chart shows you the really terrible trend we have in employment. You can see that we never really recovered, and that is even more backed up by the velocity of the M2 money supply, which is absolutely frightening. You can see we're absolutely in new lows, off the chart lows on M2. The Baltic Dry Index, you can see it's absolutely dead. It ticked above 1,000, but pretty much this level that we reached after the crash of 2008, we had a brief rally, but we've pretty much gone back to no activity. And so those are very, very ominous charts. That tells you that the Federal Reserve's strategy of lowering interest rates to zero, and then when that doesn't work, actually printing money out of thin air, it's not working. But of course, we're going to expect to see more of the same. Now, he points out in that article that the tapering is clearly not going to happen. Now, I wanted to take you over to the Treasury Direct site. You can go to that site and get the national debt. And what you do is you can specify a beginning date and an ending date. I went ahead and did January 1st, 2000 up to the present. I did the last day in July. And the anomalous series that everyone is talking about here is the length of time that the national debt has capped at this 16,738 level. You can see there's the 31st of this year, and we can begin to scroll back, and we have to go all the way back to May 31st. That's the first date we got that 16,738. Then before that, we're around 16,737. And quite strangely, we actually have higher numbers here. The highest one we can see here is going to be this 16,828 that we turned in on April 30th. And there's some 800s here, 16,700. So until we get back to about February, that's about the time when we hit this high level and have pretty much stayed there. So the question is why? Why are these numbers pegged here and they refuse to go any higher? We've been told by the government that the tax revenues in the quarter of April 15th, when the tax revenues came in, they were surprisingly better, and they said that the deficit was reduced. If the deficit was reduced, you would expect to see this figure at least fall somewhere along the line here, and it's not. This series of numbers and dates appears to be like a chart that is tapping up against the ceiling, waiting to break out, but for some reason is unable to break out. We know why it can't break out, because they have to raise the debt ceiling. So they are doing all kinds of financial chicanery. My guess is they're probably looting the federal pensions. My guess is when this is finally lifted, and I think that'll probably be in the fall with the debt ceiling vote, then it's going to rocket higher. Now, this is not an unprecedented situation. We can actually go back to a similar time frame, back to, let's go back to the same period in 2012. You can see that it hung around 15.8, not for very long. So certainly not in 2012. There was a year in this series, though, in the same time frame that I saw something similar to what we're looking at right now. So let's check 2011. And you can see that here in 2011, we got this 14,345 starting in May, and that held until about right here, the 28th of July, actually the 1st of August, and then here we go ratcheting higher. We had a $2 billion jump, and it started to rise from there. So this has something to do with the fiscal year, but clearly, and you can all link this so you can pull the series for yourself. You can pull the numbers all the way back to 1993, and you can see frightening fact that back in 2000, the national debt was $5.7 trillion, and we're currently at $16.7 trillion. So a threefold move in about 13 years. Now, do you know of anybody's wages who've gone up threefold in the last 13 years for doing the same thing? I don't think so. We could probably name a lot of prices that have gone up threefold, including gas, oil, and a lot of other things, but we probably can't find anyone's wages who've gone up threefold unless they're Wall Street banksters. So we've got definitely the government cooking the books. I'm expecting that when this number is allowed to rise, it's going to rise very, very rapidly. It's going to go through 17 and probably through 18 sometime in the fall, and the national debt will just continue to ratchet higher. Back to the silver chart. This is a very, very important pattern. The last time I pointed out a breakout target was $20.50. We had a Bernanke smackdown, and then we had these bad number releases, and then another smackdown. You have to remember the way that the silver and gold markets are currently behaving is counterintuitive. That's very common with markets because they're betting on the chance of central bank intervention. So for the paper gold and paper silver, good news is bad news, and bad news is good news. The reason why the good news is bad news is because if we get good news on the economy, and we know most of that's fake, I already showed you on the Eric King article, but if we get the fake good news, then that's more likely that we'll get some tapering sooner, less likely we'll get more quantitative easing, and therefore that becomes bad news for the metals, the paper metals again. Now, on the other hand, when we get very, very bad news, that means that there is a much less likely chance of some kind of tapering coming along and a much higher chance of more quantitative easing, either continued for a longer time or actually increased. So that's the way the markets are trading right now. All of that really doesn't matter if you're stacking silver. I did cover on the blog the latest numismatic deal, and a lot of charts, a lot of articles. So if you want to get in on that, go ahead and sign up for the membership site. But we're keeping an eye on the silver price. We're looking for that $20.50 price target. That may signal a change in trend of this long-lasting trend. And then we're going to watch and see what the price does from there. And we'll talk to you next time.